build the cash now, accumulate and build cash now for an opportunity that may come, which will be associated with crisis and bottom buying. Await the volatility to reduce until the price swings per day is less. Again, I'm not saying that means it comes down to 25 or 26 either, but I would find very strong support, I would imagine, at these levels. I think you will have a degree of support at the 50 level, but that doesn't guarantee. You should just be a blind buyer there. If it's still expansive and moving $3 or $4 a day and the volatility hasn't died down, you could get washed out and you can have a super wick go down, even if it's just for a day in one particular week of the summer.
Accumulating capital right now serves as a strategic shield against the brewing systemic instability across global financial sectors. Preparing for potential economic downturns allows investors to secure unique buying opportunities when a crisis inevitably bottoms out the markets. Francishunt, a prominent market strategist, technical analyst, and founder of the Market Sniper, emphasizes that market volatility must cool down significantly before initiating major asset positions. He argues that blind buying during massive price fluctuations only exposes investors to severe capital washouts. Hunt predicts that precious metals like gold and silver face an incredibly rough patch extending until October, meaning aggressive purchasing must be met with technical patience. While a degree of support may temporarily hold around key psychological thresholds, jumping in too early is akin to catching a falling knife. True economic preservation relies on letting asset prices settle into stable, reduced daily ranges before deploying accumulated reserves. Now, we present the clips from Francishunt's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you and enjoy the video.
One of the most useful thing, and when you were describing that particular day, you actually mentioned multiple decimals that were falling. You mentioned 100, 80, 90. I think you went as far as 70 on the day. So those were tens. That's obviously very high volatility. You are playing catch a falling knife if you jump in, even at the 70 there. Not that it was a bad entry, but now you can see we're at 57, I think. Let's have a look. I think it looks like 57 at the moment, and there's still that possibility for a little bit more in what will probably be one of the most unique economic events to come, because it's credit, it's tech, it's hyper-valued stocks that need unwinding. Eventually, the travails in the debt market will weigh on the stock market. That's when it becomes real for everyday Joes. And that's also when I see the cover of the contagion will lead to a lot of layoffs. And that's why it's hard to buy, because it's peak pessimism. It's very hard to be buying aggressively and utilizing your liquidity when neighbors on both sides of you have lost their $300,000 a year tech jobs that they were working in, and you're going in big buying gold and silver, because it's cheap right now. Wife's going, well, shouldn't we keep some buffer, dear? There's a tendency to do that, but that is the finger pulls. Wait for the volatility to reduce. Wait for marginally lower lows. So if I were to just drop a time frame on the events you were describing, you were talking about, that's a super candle there. That's very high volatility. You need the volatility to reduce. And as we teach, you often get 3 clear-cut waves of selling. For us, this is one big one. It came in an A, B, C, D. Why? Because we looked at gold. Gold largely retraced. So that's one big wave. This is, we called a head and shoulder on this, by the way. Head and then a shoulder. You only recently made that target to the downside. And we're waiting for a third selling impulse. And you can see this is a flag. Once you've made a target to the downside, you get a rally, but it's not recovery. It's a rally in downside. So because of our technical nous, I wouldn't suggest every layman that doesn't have this go about trying to pick the bottom, but I'm explaining in this situation how it all played out. You've got a bear flag dip with a pole that's over there to make to the downside potentially before things could come. And you've got a third cycle up, and then another possible down. Then we think we're done with the 3 impulses we're expecting. And that That's what makes this hard. We're not ready yet for the climbing. And now you're getting real disinflationary events, which will actually kill a lot of money. When debt gets written off, what happens is money that was borrowed into existence technically no longer exists and it gets closed down. It's a bit like a black hole. It just sucks in what once was. So the excess liquidity that was provided now gets taken out. You actually get a degree of dollar strength during that period. When I say strength, it's not because it's fundamentally well supported, but because you've had such a proliferation. Any marked reduction in that acceleration of M2 and provision actually causes a shock to the system, sees a lot of assets re-rate, and actually sees holding cash actually turn out very well, providing it's not in a bank getting failing and bankrupt. Let's say cash notes at home, for example, you avoid the counterparty risks of the system. So actually holding some cash out of banks that are in any way compromised, and I would suggest to Westerners, as always, having bank accounts and jurisdictional holdings of dollars outside the system could be very beneficial. So you could actually have a dollar shortage and a mini surge, and that could be disruptive for gold and silver as well. Is everybody else in a framing of a cup and handle? They've done this. And that's your $50 mark. In terms of how we have positioned and when we got long, we were in on a macro hunt volatility funnel setup, which is a bespoke setup that we focus on. And our setup, rather than it was a key level. I'm not going to say 50 wasn't a key level. Quite clearly it was from legacy moments. But in terms of our entry into it, we got in here as we were breaking the 25. So everyone will say, well, you can revisit the 50. You can actually run the 50. And it's still be in a breakout for us because our setup was there. You should be getting long there. And we actually had a squeeze within a squeeze here. So I'm not saying that means it comes down to 25 or 26 either. But I would find very strong support, I would imagine, at these levels. I think you will have a degree of support at the 50 level, but that doesn't guarantee. You should just be a blind buyer there. If it's still expansive and moving $3 or $4 a day, the volatility hasn't died down, you could get washed out and you can have a super wick go down, even if it's just for a day in one particular week of the summer. And I'll also highlight as a little sidebar on the summer, Elijah, we said sell in May and go away. We said new Fed chair. And we said, especially now with the hypervaluation, sell in May and go away. We haven't traded long side on the precious metals for quite some bit. I don't want to short it. I'm shorting other things like MicroStrategy and Bitcoin. Precious metals, I expect to have a bit of a rough one between now and October still. And final point, actually, sorry. The other thing that I want to highlight, first of all, happy birthday, 250 is quite some year for all my American friends that are watching this program. I know it must already feel like last year because Hormuz is warmed up, gold is slipping, a whole bunch of things are going down since your July the 4th. But did you note that there wasn't that revaluation? I want to just remind people, we're in precious metals for the certainty, the mathematical certainty that will be given grudgingly, inch by inch, with many moments like now, not knowing how far down we might come down. We are not in a once-off swing, Hail Mary lottery ticket for our enemies, the statists, to go and reval us up to the sky. And they won't give you tips and hints and QAnon type nudges on Twitter and all of that. They don't help you get rich, as you saw with Donald Trump's tax return on the crypto. So a little extra point thrown in there for good measure.
The unwinding of hyper-valued tech stocks, volatile credit structures, and massive corporate debt markets is paving the way for unprecedented economic shifts. When severe defaults and asset write-offs trigger massive disinflationary trends, liquidity rapidly vanishes into an economic black hole. This systemic contraction ironically causes brief waves of fiat currency strength, driving a massive shortage of physical dollars. During this phase, traditional safe havens face intense disruption as institutional funds sell off non-liquid holdings just to cover major derivative and margin losses. Holding physical cash outside of failing corporate banking systems eventually protects your wealth from pervasive counterparty risks. Marginally lower asset lows will appear as successive selling waves peak, offering massive valuation discounts to patient wealth protectors. Now, let's get back to the interview.
This is not supportive for the gold and silver recovery narrative in the initial instance. In the longer time frame, so initially bad, long-term very good. So why does he keep saying that? Why is it good if it starts out bad? There's a sort of dichotomy in all of that. It's almost like you're wanting it both ways. No, because eventually, in capital preservation terms, once everybody sees the loss of credibility, the spike in rates, and the devaluation. Remember, you don't want a yield. Now, it might be worth channeling a little bit of Michael Saylor's STRC. Everybody's so excited about earning 11.75%. Well, it failed to hold its 100 peg and has fallen as low as 71. It's no good to make 11.75% and then lose 30% in capital value. That moment of failure that comes later is where everybody goes, never mind the yield, preserve my capital. And that's where gold and silver come out winning. We have to go first with the yield, the higher yield bad, gold pays no yield, the yield differential, it's zero on precious metals. It might even have a holding cost if you're using bolting services, whilst bond value pays more. But don't forget, for every rate you're going up, the debt in valuation terms is going down. And when that gets accelerative, which is what they're trying to avoid but will be virtually impossible to avoid, for which the private credit, the hyperscalers, the additional corporate bond issuance, everything else, the margin debt in trading, which is at higher than 2000 levels, all those elements suddenly come home to roost, and that's when preservation comes back and is king. So first, it's yield differential. Then when everyone realizes the severity taken to the extreme, it's capital preservation. That's when gold and silver shine, but they get cheaper first, and it's an opportunity to buy because they're easily turned into cash where people have distress. People have to remember, unlike us, we tend to see things in the world of my eyes. I don't do debt. I don't own bonds of any variety, and I'm short TLT and HYG through puts. But a lot of institutions and trading and prop firms and even central banks that have treasury systems own USTs and gold. Own this and that. And when they're getting a hammering in one place, they sometimes have to borrow. And they have trading desks, and they have exposure, and there's leverage, and of course derivatives. So that leads to quick sell everything that isn't nailed down. That does come to play. So that's why in the initial instance, it's not good for gold. And unfortunately, as the higher beta version, it's usually even less good for silver. Those that aren't being washed by this, like China, for example, are absolutely grateful for the extreme discount window that is being offered and will be absolutely gorging, my opinion. And I expect to continue to see the shift from west to east on precious metals, particularly the US government here. You are going to fight tooth and nail, and it's going to be grudgingly given until they capitulate. It's not going to be a birthday gift. Hey, look, we're coming with presents for you. That's not how they operate. They aren't interested in building your wealth. They're interested in sustaining their system, which is predatorial towards you. And gold would put a restriction that would actually be beneficial for you. So why are they going to suddenly introduce gold-backed bonds or do a revaluation? Particularly when gold is the strategy of their financial enemy, which is China, who is setting up gold vaulting. The US will mislead you, but your governance, I mean by that, because you're all American that are watching, but they want the stable coin. They want the CBDC and the proliferation of the stable coin to try win out. It's not going to work. It's not buying enough treasuries. It won't sort out the excess of treasuries. So far, USDT has bought 160 billion since 2014. 160 billion is absolute chicken feed when you're issuing $1 trillion every quarter on occasions. It's 160 versus 1,000. It's kind of like I ask you to lend me $1,000 and you say, here's $160. It's not quite doing it. And that's every quarter, not every 14 years. Okay, so I don't see the CBDC option of the stable coin saving either, and there's many people pushing that trope. So we've pushed back against rate cuts. We've said higher for longer, and it's going to keep on going. You're going 6%, 6%. We push back against the revaluation narrative that's now failed, and we push back against the notion of stable coin ascendancy saving the debt market. The mathematics don't lie. The only mathematics that matters is in the long run, you win by inch and decree an eventual final capitulation. And it's not going to be a success story for the nation. It's going to be a tragedy for the nation. And you're going to be surrounded by zombies who are all angry that you got to win out. So you have to be really careful. It's a pharynx victory, you know. It's a sad victory. It's a victory none of us really wanted to have. But there is no prudence in governance in the US and the Western Hemisphere as a whole. And we have to follow principle. The principle wins. China is setting the principle. And the gold is moving from west to east as well, which is showing that in the end, principle wins. So just stay on the right side of the equation, keep on keeping on.
Global wealth distribution is undergoing an aggressive geopolitical transition as precious physical assets steadily migrate from Western institutions into Eastern central vaults. Major Eastern economic powers are actively capitalizing on current market discounts, aggressively acquiring massive reserves while Western fiscal authorities struggle with unsustainable debt creation. Western governance remains heavily committed to promoting digital alternatives like central bank digital currencies and stablecoins to temporarily mask the excess supply of government treasuries. However, the foundational mathematics reveal that these digital tools lack the capital scale necessary to absorb trillions in quarterly debt issuance. Ultimately, long-term capital protection outlasts artificial currency interventions, making physical asset ownership essential as financial systems head toward an inevitable capitulation. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.